Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Zidane, and this week we're discussing the new research and development rules and how these rules may mean an increase in taxes for some taxpayers. Get the news you need to keep your clients current, as well as new tax planning strategies to minimize taxes throughout the year at Spidell's quarterly Federal Tax Update webinar series. You can register for one session or all four at spidell.com. For taxable years beginning after December 31st, 2021, specified research and experimental expenditures are required to be capitalized and amortized over 5 years, or 15 years for expenditures that are attributable to research conducted outside the United States. This will likely surprise many taxpayers because for expenditures prior to January 1st, 2022, these amounts could either be deducted currently or amortized over their useful life. The new rules will result in lower deductible expenses in 2022 for taxpayers who have research and experimental expenditures. If you haven't adjusted your client's estimates for the year to account for the reduced deductions, be sure to account for them when preparing fourth quarter estimates. For taxpayers involved with research activities, the new rules can result in significant tax increases. Under the new rules, all research expenses are amortized beginning with the midpoint of the taxable year the expenses are paid or incurred. This is true even if the taxpayer doesn't realize a benefit from the expenditure until later. For taxable years beginning after December 31st, 2021, if any property with respect to an amortized research or development expenditure is disposed of, retired, or abandoned during the 5 or 15-year amortization period, then the taxpayer is required to continue amortizing the expenditure over the applicable period. IRC Section 174 contains special rules pertaining to land and improvements, exploration expenditures, and software development expenditures. Any research expenditures for the acquisition of land or improvements are not subject to Section 174. In other words, land and improvements are depreciated under Section 167 for depreciation or Section 611 for depletion, and non-residential properties have to be depreciated over 39 years. The new amortization rules for research or experimental expenditures don't apply to exploration expenditures to ascertain the existence, location, extent, or quality of any deposit of ore or other mineral, including oil and gas. But any amount paid or incurred in connection with the development of any software is specifically treated as a research or experimental expenditure. For taxable years beginning before January 1st, 2022, it didn't matter much whether a taxpayer classified an expenditure as an ordinary and necessary business expense under Section 162 or as a research and experimental expenditure under Section 174, because either way the taxpayer could deduct the full amount in the year it was incurred. But with the new requirement that research and experimental expenses under Section 174 have to be amortized and capitalized, the classification becomes very important. The IRS defines research and experimental expenditures as research and development costs in the experimental or laboratory sense, which include all costs that are incident to the development or improvement of a product. The regulations under Section 174 provide some, but not much, guidance regarding which expenses are classified as research and experimental expenses. For example, salaries and wages, heat, light, and power, drawings, models, laboratory materials, attorney's fees, and depreciation. Also, Revenue Rulings 73-20 and 73-272 provide that overhead and other indirect costs that are connected to research are classified as research and experimental costs under Section 174. We'll be covering research expenses and the R&D credit in detail at Spidell's Federal Tax Update webinar in January. You can see a list of topics and sign up for the live or on-demand session at spidell.com under webinars. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.